We got a little bit of a bounce. I mean, I talked there about stripping out oil and food. We're at 0.7%. Was that the reason for the bounce?
Well, I think the numbers are in line, and we'd seen a bit of a sell-off in the last 24 hours. You're under a bit of pressure, so maybe just a little bit of a squeeze there, but I suspect we'll be back to square one and lower by the end of the day, because, as you said at the top, the picture is high unemployment and inflation getting further away from their target, so they'll have to act, and I suspect that January is the most likely candidate for that.
And that, of course, is behind your 119 target for the end of next year, right?
Yeah, it does help. It does help. Not talking my own book here at all.
All right. Actually, let's stick it with euro dollar. 119, you say, by the end of next year.
Yeah.
What on the road there? Surely we're going to get a few nice bounces. Surely Draghi's going to we're going to get stuff from Draghi that is going to shift this market, this FX market, around a little bit.
Yeah, perhaps. I mean, you'd have to say the decline in euro dollar hasn't been particularly painful for those who want to be euro bears. The pushes back higher have been relatively infrequent and not that painful. So, I mean, honestly, I think 119 is a pretty glacial projection. It suggests a rather orderly decline from where we are now. The risk, I would say, is it's not so much from Draghi, is does the Fed change its tune on a strong dollar? Does it indicate that it might delay rate hikes in the US? We're not getting that yet. That could change it more than Draghi, I suspect.
I mentioned also we were looking at sterling. I know you got a cable for 148, I think, end of next year as well. And where are we now? 157.5 or thereabouts. I mentioned sterling came off a little bit on the back of this OPEC stuff. Is that the reason for that?
I've heard that spin. I think it's this idea that there's oil companies within the equity markets here are quite dominant and therefore vulnerable. I'm not convinced, to be honest. If that were the case, I would have expected euro sterling to be much higher. Euro's a net oil importer. That's not been the case really during this oil price decline. I think it's just more reflective of the fact that UK red expectations are drifting further and further out into the future. And that's part of the reason for our bearishness in sterling.
Let's throw the immigration debate in there as well. What risk does the government's hardening line on immigration and the Eurozone pose for I guess, the sterling bulls?
Yeah, I mean, I think, well, I would put that into the broader basket of political risk, and we saw with Scotland that it can get traction. We've now got immigration, and it reflects this uncertainty about the election next year. The rise of UKIP and its mandate is forcing the Conservatives perhaps down this road. I just think sterling will be weaker on politics in general, and we don't have any political risk premium in it at the moment. There should be, and there will be, I'm sure, over the coming months. Again, part of our 148 call for next year.